Most people look at debt and ask one question: how fast can I get rid of it? Investors ask a different question: what is this money actually producing right now? Picture two people. Same $100,000 loan, same 6% rate, same day it's signed. 5 years later, they can end up in completely different places, not because of luck, not because of income. The gap comes down to two things: what the money was used for, how carefully the risk was managed. The same loan can build wealth. It can also destroy it, or it can just create stress. It depends entirely on what the borrowed money produces. It also depends on how it's handled. There's a formula that private banks use to see this coming. Institutional desks run it every day. By the end of this video, you'll know that formula. You'll be able to run it on your own loans tonight. Debt itself was never really the problem. Borrowing without a plan is the problem. Let's get into the math. Section 1, the core engine. Set aside everything you've heard about debt for a second. At its core, a loan is rented money. Think about renting an apartment. You pay monthly to occupy the space. You hand the keys back at the end. Borrowing works the same way. You pay a fee for the time you hold the cash. That fee is called interest. Eventually, you return the principal. The interest rate is simply rent on money, nothing more mysterious than that. So here's the real question with any loan. Does the money earn more than the rent costs? Borrow $10,000 at 4% interest. Your cost of capital is $400 a year. Put that $10,000 into something earning 8.5%. That's $850 a year in return. Subtract the $400 rent. You keep $450 in profit. That's profit made on money that wasn't yours to begin with. The gap between what money earns and what it costs has a name. It's called the spread. The spread is the foundation of most leveraged wealth building. It's also the foundation of most leveraged failure. It just depends which direction it runs. Your return on your own cash has a name too. It's called return on equity. Return on equity equals the spread multiplied by leverage. Leverage is how many borrowed dollars you control. You compare that to how much of your own money is in the deal. Here's the equation. Return on equity equals spread times leverage. Spread is part one. Leverage is part two. Multiply them, and that's your real return, for better or for worse. Leverage amplifies losses exactly as efficiently as it amplifies gains. A consumer sees a $50,000 loan and asks one thing: how fast can I pay this back? An investor sees the same loan and asks something different: what's the spread on this money? They also ask a second question: how much risk am I taking on to get it? That second question only pays off if you're honest about the downside, too. We're going to walk through 6 ways this equation shows up. Some you can use today, others need a bigger portfolio to access. But you should see all 6. Alongside each one, we'll look at how it actually goes wrong. That part usually gets left out. Quick pause. What's the highest interest rate you're paying on any loan right now? And what is that money actually earning you, if anything? Section 2, trade credit and commercial float. Picture a small hardware company placing its first factory order. The order costs $80,000. The problem isn't demand, the problem is timing. The supplier wants payment before the customer has paid anything at all. Under the standard approach, you'd put 30% down. You'd pay the rest before the shipment arrives. With only $15,000 in working capital, that business is dead before it starts. Now imagine a different approach. Negotiate directly with the supplier's finance team. Ask for net 60 terms. The inventory arrives on day 1. The invoice isn't due for 60 days. The factory effectively becomes the bank. It's lending inventory at 0% explicit interest. Getting a supplier to accept that kind of risk takes real effort. It usually takes 3 things. First, trade credit insurance. This protects the invoice against default. Second, live sales data. This proves a fast inventory turnover. Third, a 210 net 60 structure. This offers a small discount for early payment. It also preserves the full 60-day window if it's needed. With those 3 pieces in place, the supplier ships $80,000 in product. Zero cash goes down up front. Say the campaign sells through by day 42. That generates $112,000 in revenue. The invoice gets paid on day 58. That's 2 days before it's due. $32,000 is left over as profit, and $0 of personal capital was ever tied up. That's the appeal of trade credit. Serious operators value payment terms more than raw cash. Terms buy time, and time is what lets revenue arrive before the bill does. But it doesn't always work this cleanly. If the product doesn't sell through in time, the bill is still due. The full invoice comes due on day 60, sold or not. Float only works when the sales cycle beats the payment terms. Used carelessly, it just delays a cash crunch. It doesn't prevent one. If you sell anything, ask your suppliers for 30 or 60-day terms. That turns them into a short-term lender. It's often interest-free, worth checking if that's already available and simply unused. Section 3, Real Estate Refinancing and Recycled Equity. Now consider the BRRRR model: buy, rehab, rent, refinance, repeat. This is where a lot of finance content gets the math wrong. It skips the risk side entirely. Picture a distressed single-family home in Florida. It has severe water damage. No traditional buyer wants to touch it. That means it's priced well below market at $350,000. Here's the full breakdown. Purchase price, $350,000. Renovation cost, $100,000. That covers a new roof, an added bedroom, and updated kitchen and baths. Holding costs and fees add up to $50,000. Total cash outlay, $500,000. That's financed through a hard money loan, plus $150,000 of the investor's own equity. Once renovated, the property gets leased at $4,200 a month. Now the investor pursues a cash-out refinance. Suppose the appraisal comes back at $700,000. At 80% loan-to-value, the new mortgage is $560,000. At closing, $500,000 pays off the original loan and fees. The remaining $150,000 comes back as cash. Refinance proceeds generally aren't treated as taxable income, but that doesn't mean the money is free. The investor has replaced equity with debt. The property is now more leveraged than before. The safety margin is thinner too. Here's the part that matters most. It's also the part that usually gets skipped. The mortgage balance jumped from $400,000 to $560,000. At today's rates, that's a real increase in payment. If local rent doesn't comfortably clear that new debt service, this move backfires. It doesn't create wealth, it creates a monthly cash flow leak. That leak shows up once rates rise or once there's a vacancy. The refinance itself isn't the win. The win is finding a deal where rent clearly outpaces the new debt. Plenty of investors have run this exact playbook backward. They refinanced into a payment their rent couldn't support. Worth asking, for any property under consideration, is the goal to pay off the mortgage fast, or is the goal to recycle the down payment into another asset? And if it's the second option, is there enough margin to survive a bad year? Section 4, buy, borrow, die. This is the mechanism behind a familiar headline. Very wealthy individuals pay low effective tax rates. That happens despite large gains in net worth. It's not a loophole. It's 3 ordinary rules stacked together. Step 1, buy. Appreciating assets grow net worth on paper. Think index funds, equities, real estate, private stock. Unrealized gains aren't taxed under current law. Nothing is owed until something is sold. Step 2, borrow. To access cash without selling, an investor can pledge a portfolio as collateral. This is done through a securities-backed line of credit. Consider an investor with a $2 million portfolio. Their cost basis is $800,000. They need $300,000 in cash for a business opportunity. Selling $300,000 of stock would trigger capital gains tax, plus the net investment income tax. Combined, that's about a 23.8% hit, over $71,000 gone immediately. Instead, the investor pledges the portfolio. They draw $300,000 at a 6% rate. That costs about $18,000 a year in interest. It's generally deductible as an investment expense. If the portfolio grows 9.5% that year, that's $190,000 in gains against just $18,000 in interest cost. But this only works under one condition. Growth has to actually outpace the borrowing cost. The portfolio also needs real cushion against a downturn. In a flat or down market, that $18,000 in interest is still owed. Nothing offsets it. The loan doesn't disappear just because the portfolio didn't grow that year. Step 3, die. Heirs typically receive what's called a stepped-up basis. The asset's tax cost resets to its value at the time of inheritance. Decades of gains are never taxed as capital gains. Under current law, the federal estate tax exemption is substantial. It's roughly double for a married couple. That's often enough for an estate to clear outstanding loans without ever triggering capital gains tax. This particular structure needs a sizable starting portfolio. But the underlying idea scales down. Borrow instead of selling when growth outpaces the interest rate and when there's real risk cushion. This strategy only holds up when three things stay aligned: asset growth, borrowing cost, and risk management. Remove any one of those, and it stops being clever. It just becomes expensive. Section 5, where leverage turns on you. Before moving to consumer-level tools, let's talk about how leverage fails. This part usually gets left out entirely. Lenders extending credit against a portfolio set maintenance limits. Often, debt has to stay under 50 to 60% of collateral value. Say the market drops 40%, a $2 million portfolio falls to $1.2 million. A $700,000 loan suddenly sits near that 60% threshold. The brokerage issues a margin call. Without new cash within 24 to 48 hours, the position gets liquidated, usually at the worst possible moment. That's typically near the bottom of the decline. Leverage multiplies a positive spread into real gains. It multiplies a negative spread into real losses. Both happen on the same schedule. Neither waits for patience. Short selling carries a version of this with no ceiling at all. Buying a stock caps your downside at 100%. It can only go to zero. Shorting a stock means betting on a decline. There's no upper limit if the price rises instead. The lesson isn't that leverage is bad. It's that leverage doesn't distinguish between a good decision and a bad one. It just makes whichever one you made bigger. Keeping loan to value well under typical thresholds isn't about maximizing upside. It's about surviving being wrong occasionally. Everyone eventually is. Section 6, 0% APR balance transfer arbitrage. At the consumer level, this same idea shows up in balance transfers. You move high-interest debt onto a new card. That card offers 0% for a fixed window, usually 18 to 21 months. In exchange, there's a one-time fee, usually 3 to 5%. A 3% fee on a $40,000 balance is $1,200. Spread across 21 months, that's a low effective cost. The true annual cost of that capital is roughly 1.7%. Picture someone carrying $40,000 at 21.5% interest. That's around $8,600 a year in interest alone. That's over $700 a month for nothing. Now picture transferring that balance to a 21-month 0% offer. Pay the $1,200 fee up front. Set up automatic payments of about $1,962 a month. The total interest paid drops sharply from roughly $11,500 down to just the $1,200 fee. That's a meaningful reduction. But one condition has to hold. The full balance actually has to get paid off before the promotional window ends. That last condition matters a lot. If the balance isn't cleared in time, the rate reverts. It often reverts to a high standard rate, sometimes higher than the original card. That turns a strategy from a savings tool into a trap, only for anyone who doesn't stick to the payoff schedule. Used offensively, that same low effective cost can fund short-term needs. Think inventory or an ad campaign. That only works if the return is realistic, not just assumed. Worth checking a banking app for any existing 0% transfer offers. Run the actual math on what you'd save, and check whether the full balance could realistically be paid off in time. Section 7, credit score and the cost of borrowing. The return on equity formula has two sides: the return an asset produces and the cost of the debt. Most people focus entirely on the first side. They chase higher returns. The second side gets far less attention. Lowering the cost of debt carries no market risk at all. Credit score is the main lever on that cost. The national average FICO score sits around 718. Look at a $600,000 30-year mortgage. Compare a 660 score to a 760-plus score. At 660, the rate is roughly 7.25%. That's about $4,092 a month. At 760-plus, the rate drops to roughly 5.65%. That's about $3,463 a month. The gap is about $629 a month. Over the life of the loan, that's over $226,000. Some borrowers have raised their scores meaningfully within a few months. A few moves tend to matter most. Reducing credit utilization is one. Correcting reporting errors on a credit file is another. Lengthening account history helps too. For example, pay most cards down close to zero. Keep only minimal utilization on one card. Dispute an inaccurate mark through a formal request to the lender. Consider becoming an authorized user on a long-standing, well-managed account. Results vary by starting point. There's no guaranteed timeline. Improving a credit score costs nothing in fees, but it permanently lowers the rent on every dollar borrowed. That's arguably a safer place to focus, safer than chasing higher risk returns. Conclusion and call to action. Debt is rented capital, nothing more, nothing less. Used without a plan, it funds things that lose value. That traps people in a negative spread. Used deliberately, with real attention to risk, it can help control assets that produce cash flow. But leverage doesn't create good outcomes on its own. It just makes the outcome bigger and faster. Good or bad, here are 3 things worth doing today. First, list every loan you're carrying. Note the rate on each one. Compare it honestly to what that money is actually producing. Second, deal with high-rate debt first. If anything is above 10%, a 0% transfer makes sense. An accelerated payoff plan works too. Third, lower your cost of borrowing before chasing higher returns. Reduce your utilization. Correct any errors on your credit file. It's a lower risk lever than most people realize. If this changed how you think about debt and risk, hit like and subscribe. Pass it along to someone weighing a decision like this. Thanks for watching.